Hello, in today's video we'll be taking a look at the Friday, October 10th, 2025 trading session for the CBOE SPX index, and we'll be trading SPX 0DTE options utilizing the day trading GPS SPX Daily Key Levels indicator, specifically the V2.0 version of the indicator, which was released 2 weeks ago. Okay, so some of you may already be familiar with how this indicator works from watching our other videos that we've put on our channel in the past, but for those who are new to the channel, who have not seen any of the videos before, I'll briefly run through how this indicator works. So at 9:30 a.m. Eastern New York time, the CBOE SPX index market opens. So at the market open, you will get the key levels on your screen along with these two tables here, and you'll have the line labels for the various key levels for today's session. You can also get these levels, the bull bear key price level and the main R&S levels for today's CBOE SPX session 30 minutes before it opens by utilizing the indicator on a second chart on a second symbol that the indicator also works on, which is the SPX 500 8 cap 4x CFD that is on TradingView. So if you want to have a second chart open with the indicator on that particular SPX 500 8 cap symbol, then at 9 a.m. Eastern New York time, 30 minutes before the main CBOE SPX index opens up, you will see the levels for the SPX 500 8 cap on that chart, but you will also have two tables on that chart, one like this for the SPX 500 8 cap levels, as well as a second table which will display the levels for today's session for the CBOE SPX index. So that is the way that you can get the levels 30 minutes before the CBOE SPX open, as the indicator already knows what they are at 9 a.m. The reason that you have to get them early by utilizing the second chart is because that 4x CFD does trade in the pre-market and overnight. So the way TradingView works is that if the symbol you have your chart on is closed, and at 9 a.m. the CBOE SPX index is still closed because it doesn't open until 9:30. So even though the indicator already knows what the levels will be for CBOE SPX, it cannot display them because of PineScript's coding. The way it works is that there has to be a tick on the chart, and if the market's closed, there's no tick on the chart, so it can't display the levels. However, if you have it on the second chart, the SPX 500 8 cap CFD, then you can see the additional table, which will at 9 a.m. show you the levels for today's CBOE SPX session 30 minutes before it opens. So if you want to see them before it opens, then you can have that second chart open. If that doesn't matter to you seeing them early, then you can just simply have your chart on the CBOE SPX index, and then at 9:30 a.m. Eastern New York, when the first tick happens, then you will get today's levels on your chart. Okay, so the key levels on the chart that you'll get at 9:30. The main, most important level for the session is the SPX Bull Bear KPL, which stands for Key Price Level, which the indicator gave for today's session the Bull Bear KPL of 67.3985. So what this means is bullish above this level and bearish below this level. So this is giving you this the determining level for session bias. And then for trades that are taken off of this level, that are taken off and derived from this level, your levels above the bull bear KPL are your take profit levels for bullish trades taken off of this level, and the main levels below the bull bear KPL are your take profit levels for bearish trades taken off of the bull bear KPL level. So above the bull bear KPL level, the default settings for the indicator are that you would have the main levels of R1 through R6 on your chart, and below the bull bear KPL the main levels are S1 through S6. We happen to have additional level of R7 and S7 turned on today because of how price action turned out and the volatility that was here in today's session. But the indicator can go up to 10 levels above and below for extreme volatility, such as we saw in the COVID pandemic, or when we have days like today when we have extreme volatility. So those are all in the user control panel. You can turn off or turn on as many of the main levels that you wish to see on your chart. Normally it will display by default R1 through R6 and S1 through S6 along with the bull bear key price level. But you can turn off or uncheck the levels that you don't wish to see if for some reason you just want to focus on, say, maybe the first 3 levels above and below. You can also do that as well. We do have a video that goes into all the features of this indicator, as well as all the inputs in the user control panel, which we're not going to go over all the features and inputs in this video today. If you'd like to send us an email at daytradinggps@gmail.com because you would like to see that video to see all the features and all the inputs in the user control panel. That video is about an hour long, and if you want to request that link to that video, then we can send you the link to that. Also, if you have an interest in purchasing this indicator, if you want to email us at daytradinggps@gmail.com, you can, in return for your taking your time to watch this video today, you can request a discount promo code that you can utilize to purchase the indicator at the link that is in the video description. So if you would like to get a substantial discount promo code, just simply email us requesting that promo code and we will send it to you. Okay, so the other levels that you see here, you'll see that we also have midpoint levels between the main levels. So here's the midpoint level between R1 and R2. Here's a midpoint level between S1 and S2. Here's a midpoint level between the BBKPL and S1. Here's the midpoint between S2 and S3, etc. The midpoint levels are utilized for to gauge continuing momentum in a direction, and they also serve another purpose to be used as standard stop losses, standard stop loss levels, depending on whether you're taking a bullish or bearish trade, and they are utilized and depending on which level that you're taking the trade being triggered from. So in the case of the SPX bull bear key price level, on a bullish trade your standard stop loss is the first midpoint below, and on a bearish trade derived and triggered from the bull bear key price level, your standard stop loss would be the mid BBKPLR1, which is the first midpoint above. If, for example, you were taking a bearish trade off of S1, then your standard stop loss on that trade would be the first midpoint level above S1, because S1 is the level you're taking the trade from. If you were taking a bullish trade off of S1, then your standard stop loss would be the first midpoint level below S1. and so on and so forth. So at the end of this video, there'll be a 25-minute section on how to take trades off of the other levels. Today we're primarily focused on the trades that are based and triggered from the bull bear key price levels, since that is what happened today with these two trades. But at the last 25 minutes of this video will be in a appendage to this video of 25 minutes that will go into taking how to take trades off of the other main R levels and S levels, as well as the stop losses to use, whether it's bullish or bearish. And it will also discuss the two different types of trade entries, one being your standard trade entry and how to recognize that, and then the other one being the more conservative trade entry, which requires additional confirmation, and how to recognize that. Okay, so in the session here we have the 9:30 a.m. candle for today's session marked off here. We're on a 2-minute chart. 2-minute chart time frame is the recommended time frame to use for this indicator for intraday trading. The indicator does work on time frames of 1 minute up to 30 minutes. If you put it on a time frame that's greater than 30 minutes, such as an hour or 2 hour, there will be a disclaimer that comes up on your screen telling you to put it back between a chart time frame of between 1 minute and 30 minutes. So for intraday trading, generally the 1 minute chart time frame up to 5-minute chart time frame are going to be the most recommended time frames to use, with our recommendation as far as a time frame being within the 1 minute to 5 minute being the 2-minute chart time frame. And if you have seen our other videos or want to look at our other videos, you'll see that that is the chart time frame that we use in all the videos. Okay, so briefly these other levels here that you'll see that there's a table for. The YDH level is yesterday's daily high. What that specifically stands for is the previous RTH session high. PMH is the current session's pre-market high. YDC stands for yesterday's daily close. What that specifically means is the previous day's RTH session close. PML is the current day session's pre-market low, and YDL stands for yesterday's daily low, which specifically means the previous day's RTH session low. Those levels can also be very useful for additional support and resistance levels depending on the context of the session that we're in. And as we'll get to in a minute, they can also be used for target exits depending on where they're located in relationship to the amount of the move that has already occurred and whether the minimum target amount of a minimum required move has already been met. They can also be utilized if they're beyond that minimum target as additional levels for either closing out your positions or scaling out and making a further adjustment to your positions. Also, these two tables here that you'll see, those can also be turned off in the user control panel if you don't wish to see them on your screen, because as you can see here, you also have line labels which give you all the information about each level as well. So if you feel these are unnecessary for your purposes and don't wish to see them, then you can simply uncheck them and turn them off. Okay, so just getting into the trade entries here. So our first entry was a bullish entry on the 9:30 a.m. candle. So why is this a trade entry on this candle? Because the candle is closing above the bull bear KPL. So specifically, this is the opening 9:30 a.m. candle, and it opened slightly above the bull bear KPL. It could have opened below it. The main point is that it closed above the bull bear KPL. So where it closes is the most important aspect of this opening candle. If instead the opening candle had closed below the bull bear KPL, then instead of looking at a bullish play off of this candle, then we would instead be looking at a bearish play. Now, there's no rule or obligation that says that you have to take a trade off of this 9:30 a.m. candle. You can certainly wait till the session breathes a little bit and instead take your trades off of other levels, and you don't necessarily have to take it off the 9:30 a.m. Level. And we'll go over that in, like I said, the last 25 minutes of this video, where we go over taking trades off of the other levels. But just keep in mind that it's optional. You don't have to take this trade off of the 9:30 a.m. Some people don't like to take opening trades, but that would be the rule for those that do wish to take it. And just keep in mind that usually in 90-95% of the sessions, that in the first opening moments of the session, most of your trades are going to be off of the bull bear key price level. Okay, so in this particular instance, we have a close above the bull bear KPL, which we'll also be referring to as the BBKPL throughout the video. And how do you determine which SPX option strike to use for this bullish play? So there's basically three options. So the primary, or what would be considered the standard play, bullish play, for the option that you would pick for a trade that is triggered and derived from the bull bear key price level would be an at the money option and the closest strike to the bull bear KPL price. So today it's 67.39.85. SPX trades, so for those of you who are not familiar with SPX, it trades in 5-point increments. So for example, 67.35, 67.40, 67.45, etc. So the closest at the money strike is the 67.40. Since this is a bullish play, that would be a call option. So the 67.40 call option. So the at the money call option is what would be considered the standard bullish play. For those that prefer out of the money options, then there's basically two choices here. So since this is the level that the trade is derived from and it's a bullish play, your two choices are slightly out of the money based on what strike is closest to the first midpoint above the trade that the level is derived from. In this case, it would be this midpoint here, 67.45.49, so that would be the 67.45 call option. Your last and final option, because you don't want to go further away than this amount out of the money, would be whatever the closest strike is to the R1 level, since that's one level away above, and this is a bullish play from this particular level. So this is 67.51.12, so that would be your 67.50 call option. But like I said, the standard play is the at the money. So in this case, the at the money 67.40 call option strike on the close of this candle was $17. So if you're not familiar with the way options work, the price is $17. But what you'd be paying for one option would be $1,700, because you multiply the $17 by 100, and that is what one call option is going to cost you. So if you wanted to buy two call options, it's going to cost you 2 times 1,700, which would be 3,400. If you wanted to buy three, it's going to be 3 times 1,700, which would be 5,100. If you wanted to buy 10, it's going to be 10 times 1,700, which would be 17,000. Okay, so how do you determine what stop loss to use on this particular trade? So on how you figure out the stop loss is the standard stop loss is on a bullish trade is the first midpoint level below the level that you're taking the trade from. So in this case, the level we're taking the trade from is the bull bear KPL. The first midpoint below is this level here, mid BB KPLS1. That's 67.3422. So that would be your standard stop loss on this bullish play. If you prefer to use a tight stop loss, although we do recommend that you use the standard stop loss, for those that prefer to use a tighter stop loss, then you use the first QL level below on a bullish play, the first QL level below the level that you're taking the trade from. So in this case, that would be the QL below BBKPL 67.3703. Now, tight stop losses are more prone to getting stopped out. So even though because you're using a tighter stop loss, you'll technically have less money at risk via that stop loss, then you also just have to be aware of the fact that they are more prone to getting stopped out, and that's basically the trade-off in using them. So whichever one you use is completely up to you, at your choice, your discretion. However, the recommendation is that you use the standard stop losses on trades. Okay, so as you can see here, we did get the move above with the close. We purchased the option for $17. We've set our stop losses. Now what about exits? So if you've seen our other videos, we talk about there basically being a minimum target for considering either a 100% closeout of all your positions or scaling out of 70 to 90% if you are trading multiple options, or scaling out of 70 to 90% of them and adjusting your stop loss on the remaining runners. So what that means is whether you're trading one contract or 10 contracts or 5 or 20, you can either close out all of them 100%, or if you're trading multiple contracts, then selling 70 to 90% of them, such as if you had 5 contracts and you sold 4, that's 80% of the 5 contracts. You're leaving one contract, and then you're adjusting your stop loss on that remaining one runner option contract. So now you can, instead of closing out, also adjust your stop loss on all of the contracts if you prefer not to scale out. However, if you are going to do an adjustment, typically it is better to do an adjustment if you are trading multiple contracts, and because you're closing out, guaranteeing you a profit 70 to 90% of them, and then just adjusting the stop loss on the remaining runners. But that is completely up to each trader for their own individual risk management profile to decide for themselves. Okay, so the way it works with this indicator is that there's two different types of trade. Either you're a scalper, or you're taking regular trades and wanting to get out at what is considered with this indicator to be the regular exit target levels. So if you are a scalper, then what you're looking for in the case of being a scalper is a one level move that is one level away from the level that the trade is derived from, that you took the trade from. So in this case, the bull bear KPL is the level that the trade is derived from, that we're taking the trade from. So the midpoint above is a half level, and the R1 level is the one level above. So that's one full level above. So that's where you would get out if you're just scalping. And if you were just scalping, then there is no adjustment. There's no scaling out. It's 100% closeout on scalping. So as you can see here on this 9:34 a.m. candle, this is where you would have gotten out here if you were just scalping, and then you get out 100%. Now, if you're not scalping and you're just doing regular trades, then as you've seen in, or you may have seen in our other videos, the minimum amount of level move that you are looking for in the direction of the trade is going to be a 1.5 level move. And the ideal amount as far as a minimum target is a 2 level move. But the absolute minimum would be a 1.5 level move. So how do you determine what a 1.5 level or 2 level move is? It's just simply the level that you're taking the trade from, that the trade is triggered from or derived from, however you want to phrase it. In this case, that's the bull bear key price level. So as we just went over scalping, this is one level above. So you just look to the next half level, and that's your 1.5 levels, because it's 1.5 levels above the level that we took the trade was derived from. So that's mid R1, R2, 67, 56, 76. So as you can see on the 9:36 a.m. candle, it does hit that level, and on the close of that candle, the 67.40 call option is now 23.80, and that is a $680 profit per option. So again, you're either closing out all of your options here on this minimum target. That's up to you to decide if you're just fine with the minimum 1.5 level target or not. So if you are, and that's going to be your process, then you would close out 100% of your contracts here, or you would make an adjustment to your stop loss. If you are going to make an adjustment to your stop loss instead of closing them out, then it's typically better to do that if you have multiple contracts, because then you can scale out and close out 70 to 90% of them, guaranteeing you a nice profit, and then you're just adjusting your stop loss on the few remaining runners. By adjusting the stop loss, what I mean is this. So adjusting the stop loss means adjusting it to break even. So you started off with a stop loss that's based on levels, as we went over here, tight stop loss and standard stop loss on this bullish play. At the point of making your initial adjustment, you would adjust your stop loss numerically just to break even, being the price that you paid. So in this case, $17. So you adjust your stop loss on any remaining runners to $17, or you adjust your stop loss to break even plus a profit cushion, which on an initial adjustment should be somewhere between 10% to 15%. So if you did a 10% profit cushion add-on, then that would be $1.70. So that would mean your adjusted stop loss with the 10% profit cushion would be $18.70. So at this point where it's $23.80, you sold 70 to 90% of your contracts. If you were trading multiple contracts and wanted to scale out and adjust, and then on the remaining contract, if you wanted to just break even, you adjust it to $17 on the stop loss. If you wanted to have break even plus a 10% cushion, then you would adjust it to $18.70. Or as we discussed, your other option is to go ahead and close them all out at $23.80 and have a $680 profit per option. Now at 9:46 a.m. it hits the R2 level here, as you can see here on this candle here. That is a 2-level move. So it's a 2-level move because SPX bull bear key price level to R1 is a 1-level move. That's 1.5 to this midpoint, and then that is a 2-level move. On the close of this candle here, as you can see, the candle did pop, have a wick that did hit it, and then it basically came off of it a little bit and then closed slightly below it. And this price is based on the close of the candle, 25.70. So at that point, closing on that candle close, you have an $870 profit per option. And remember, as we discussed, that basically a 2-level move is the ideal level for making this adjustment, although the minimum that you can do it at would be the minimum 1.5 level move. So that's really up to each trader to decide for themselves if they're just happy with a 1.5 level move or they prefer a 2 level move. However, just keep in mind that the reason that we have 1.5 level move as a minimum target on a regular trade as opposed to a scalp is because with this indicator, that's typically going to be, in most cases, the start of a possible turning point where price may just start trading sideways or start retracing. So that's why that is the minimum, whereas the second most often is going to be the 2 level move. Okay, so you've either closed out or you've either closed out 100% or you've scaled out and adjusted your stop loss either here or here on a regular trade as opposed to a scalp. So as you can see here, price did retrace. So if you did an adjustment on the remaining runners, you would have gotten stopped out, or but you still would have had a nice profit on closing out 70 to 90%, like we talked about, or you either closed out 100% of your positions and you are already out of the trade completely, either here or here. Okay, so then we have this price action here, which is happening today because during the first part of the session, President Trump came out and made some statements about China tariffs, that he wasn't too happy with some things that were going on, and that he was going to consider significantly increasing by a huge amount the tariffs on China. And so the market took that badly and decided it was time, after all these recent making all-time highs, for finally having a huge sell-off. So as you can see here, we had in this one candle here at 1056, we had a cross below and a close below the bull bear KPL. So remember, we're already out either because we scalped here or we closed out 100% here or here, or we sold 70 to 90% and left remaining runners with an adjusted stop loss to break even or better, which in this case we would have been stopped out on the remaining runners. And so currently we would be in no position here. So this would be a new trade we would consider here on this cross below and close below. So you're taking a trade on the cross below, close below, on the close of this candle, on the 10:56 a.m. candle, which of course closes at, since it's 2 minutes, at 10:58. So here it's the same process as it was before. This is the same level that the trade is derived from, the bull bear key price level. However, in this case, it's the exact opposite of this. Now we have a close below. So now we're looking at a bearish entry, which will be using put options. As far as the put option strike that you would be using, it's the same process we used over here. So your standard is going to be the same at the money. Whereas we use 67.40 over here, we'll be using 67.40 over here as well. Except in this case, we'll be using a put option. The entry price on the candle close of this put option was $13.50. And again, we'll be taking a look at the Thinkorswim option charts here in just a little bit. Alright, so since this is a bearish play, then in determining our stop losses on a bearish play, it's just the exact opposite of what we did earlier. So this is still the level that we're trading, trade is derived from, triggered from. Since this is a bearish play, now our stop loss is going to be the first midpoint above the level that the trade is derived from. In in this case the bull bear KPL. So our stop loss is going to be the mid BBKPL R1 because that's the first midpoint above, or if you're using the tight stop loss, it's the first QL above. Okay, so as you can see here, this was a fast and furious sell-off. And in just the very next candle, it hits all of these levels. So you can see this is our entry, and then the next candle, it hits mid S1, S2, S2, yesterday's daily low, as well as mid S2, S3. Now it backed off of mid S2, S3 and then closed, and it still closed below YDL and S2. But it did hit all these levels in this candle. The 67.40 put option that we bought for $13.50 is now $30. So that's a $1,650 profit per put option. So again, your choices are here, just in this one candle, we've made a 1.5 level move. So even if you were scalping, you would have gotten out because that's a 1 level move from here to here. Or whether you're doing a regular trade, you still got all 3 levels. You got all the levels here, no matter what, in this one candle. So you have the 1.5 level move here down to mid S1, S2. So that's just to go over how that works again. Half level below is this. 1 full level below is S1. 1.5 level is the mid S1, S2. A full 2 levels is S2. And then 2.5 levels is S2, S3. So in this case, you can see how fierce the sell-off was, and it hit all of them in this one candle. So this price of 30 is based on the close of this candle after it backed off. It was greater than that until it backed off and closed. So this $30 is based on the close of the candle. So at this point, it's the same thing you had up here. Since it's hit the minimum targets, both the 1.5 and 2 levels in this one particular candle, it's the same process. Either you're closing out 100% of your contracts, or you're making an adjustment to break even, or break even plus 10 to 15% add-on profit cushion. So break even at this point would be $13.50, or you would add 10%, $1.35, which that would make that $14.85, or you would add up to 15%. So that would be roughly like $2.20 or so. So that would make it $15.70 or so. Or you're scaling out of 70 to 90%, as we talked about before, if you're doing multiple contracts, such as you have 5 and you sell 4. And you're making the adjustment on the remaining runner that you have. So if you had 5 and you sold 4, then you have 1 remaining runner. If you had 10 and you sold 7, then you have 3 remaining runners. If you had 10 and sold 8, then you have 2 remaining runners. Okay, so the rest of these are going to be, there's going to be quite a few of them. We don't really have room to just squinch up the chart and have all of them here. We only have the first 2, but we'll be going down through all of them, since this happened quite fast. So these would be coming into play. So you're either out right here because this hit all the levels 100%, or you kept all of your contracts and adjusted the stop loss. But normally we say that if you're going to do that, you're better off scaling out of the multiple contracts 70 to 90% and then leaving runners to adjust the stop loss on. So if you just want to look at these other ones as the remaining runners that you adjusted the stop loss on, then the very next candle, as you can see here, is another forcibly down candle that hits S3. So on the close of this candle at 11 a.m., the 67.40 put is now $50.75. So that's a profit of $3,725 per put option. Then as you can see here on this candle at 11:18, it hits both mid S3 and S4. So we have mid S3 hit as well as on this wick the S4 hit. The price on the close of this candle after it backed up above S4 and closed here is now $64.22. That's a $5,072 profit on per put option. Now in the very next candle at 11:20, it hits mid S4 S5, as you can see here. On the close of this candle, the 67.40 put option is now $76.65, and that is a profit of $6,315 per put option. So keep in mind that if you have runners that you initially adjusted the stop loss on, remember back here at the 1.5 level to 2 level move, and you have remaining runners that you adjusted the stop loss to break even or the 10 to 15% buffer, that at each level that it's hitting, then you would add more. If at each level it's hitting, you have another decision to make, either closing out and the rest of your runners, or adjusting the stop loss further on the rest of your runners. So adjusting the stop loss, if you're not closing out 100% of what's left, then you're adjusting the stop loss on the rest of your runners. So remember, we paid $13.50, and so here we were making an adjustment to $13.50 break even, or we were adding 10 to 15% to the $13.50 as an adjustment with a profit cushion. But now the option is $50.75. So what could you do now? Well, the amount of the adjustment to your stop loss now when it hits here is completely up to you as to how much you want to add back in and adjust it from where it was here to a new adjustment. But one thing that you consider doing is that if it's $30 here and now it's $50, you may just want to adjust it, if you're not going to close out all the rest of them here, that on whatever ones you're going to leave, that you adjust it to at least 30, because that was the prior one up here. And then you would keep doing that as it moves down. So as you can see here, at mid S3 at 11:18, it hits mid S3 and S4. And now it's 64.22 on the close of this candle after it hits S4 and bounces up. Now as you can see here, if you had made an adjustment when it hits here to 50.75, then you would have gotten stopped out here on the remaining runners, because it did excuse me, I'm sorry, pardon me, it did not, it only retraced back up to here. So at here you would have at the 64.22 level, you're making your adjustment to 50.75. Excuse me. Okay, and then when it gets down here and hits the mid S4 S5 level, it's now $76.65, and you have a $6,315 profit. So again, you're either closing out all the remaining runners, or you are going to adjust your stop loss again on any remaining runners you still have. And what do? You adjust it back to the level that you had before, which would be 64.22. Well, as you can see, it did not go back to that level. It still continued down. And so here at 11:24, you can see that it hits the S5 level here on the 11:24 candle. So on the close of this candle, which this one happened to follow through and close below it, this put option is now $91.55. So you have a $7,805 profit per option. So again, if you have any runners still left over, then it's either 100% close out now or adjust on the runners again. And so in this case, you would be adjusting it on the runners again back to 76.65 when it hit the 91.55. Now you don't have to follow this exact thing how I've pointed out here. This is just to give you a guide as to how you might want to further adjust your stop loss. You don't have to follow that. You can certainly adjust it to what you want. You could certainly just add 10 to 15% on each one of these and not move it up as much as we did here, meaning add 10 to 15% more for each level it moved down instead, which would be a lot more liberal stop loss than these would be once it starts moving down. So as you can see here, this was the 91.55 here on this close, and then if you adjusted it to 76.65 on the remaining runners, your stop loss, more than likely you would have gotten stop loss. You would have gotten stopped out finally on this candle because it did wick back up to that level. So more than likely you would have gotten stopped out right here at your 76.65. Now, if you happen to use a different one than that and you did not get stopped out, then there was still more profits to be had here, because as you can see here on this 11:30 candle right here with this very long wick, $11.30, it hits mid S5 S6. The 67.40 put option is now $101.50. That's $8,800 profit per option at this point. So again, the same decision to make: either 100% closeout of any remaining runners or continue to adjust. And as you can see here on the very next candle, we have at 11:32 a.m. it actually hits the S6 level. It does not back off of it. It actually closes through it, has a small wick here below it. But on the close of this candle, it's now $111.62, so that's $9,812 profit per contract. Same decision: either close out the remaining runners or continue to adjust. Now, as you can see here, we did get a retrace back up after this, so more than likely on many adjustments that you made, you would have finally gotten stopped out on that eventually. But as you can see here, after they kind of lured people back in here, then they began to sell off again. Now, when I started making this video, we had not was back here, so this had not occurred yet. But since we're still live in the session now, it's now 1:49, which would be this here. As you can see, we finally hit the S7 level, and on this candle here. So more than likely, remember, this candle here hitting S6 is actually, that's S6 here. This is S5 here for this one. Mid S5, S6 here for this one on this candle. S6 is this candle here for this candle. As you can see here, this is where it touches mid S6, S7. So you would have had another one here. This probably is about 121 or so when it hits here. And then you have finally this candle here, where it does hit S7. So the difference between S7 and S6 is about $23. So if you add $23 or so to this 111.62, so when it hits down here finally at S7, then you add about $23 or so here. So this would have been about $134 here. So remember, we paid $13.50. So at $134, that basically means that you would have about $12,000 profit per put option if you happen to have any remaining runners left when it hits this S7 level. So as you can see here, this is a day no one was really expecting this sort of sell-off today. So again, you just get news coming out of the White House of these China tariffs, and all of a sudden you do get a sell-off. So that's why this indicator, like I said earlier on in the video, it does go up to R10 and S10 because there are going to be days every now and then when you will get very large moves. It's still possible that before we still have a little bit over 2 hours left in the session, and depending on what news may come out later on in the session, we may actually sell off all the way down to S10. But we'll just see what happens. We may just get a turnaround here, and the sell-off may be over, and we may be just moving back up. But anyway, right now we're going to go into the last part of the session, which I explained earlier, which is going to be 25 minutes, which is going to go over how to take trades off of the other main R and S levels when you get throughout the rest of the session, and then also the two different type of trade entries, one being your standard trade entry and the other one being the more conservative approach, which some of you may prefer, which requires further confirmation in order to have a trade entry. So thank you for watching this part of the video. Now we'll go into the next part of the video, which will go over all that. Again, if you have an interest in purchasing the indicator, if you want to send us an email at daytradinggps@gmail.com, then you can request a discount promo code, and we will send you a discount promo code to give you a significant discount off of the normal price. All of our indicators are sold on a one payment for lifetime access basis, which means that you make one payment and then you have access to the indicator for life. It's not a monthly subscription or anything like that. You just make the one payment and then you have the indicator for life. And then also you're also entitled to receive any future enhancements or future versions that come out of this indicator, which we do have some planned in the future. We'll be coming out with a V3.0 version soon. At that point, when that version comes out, the price will be going up substantially because it will have some substantial new features in it. So if you do have an interest in getting the indicator, you can purchase it now at the current price, also apply that discount promo code, and then you'll be also entitled to receive any future versions at no additional charge. Alright, now we will first go into looking at the Thinkorswim charts, and then we'll go into the last 25 minutes of the video. Okay, now we're going to briefly look at the Thinkorswim option charts. These are 2-minute candles, just like the chart we were working off of. So here is the 9:30 a.m. close above the BBKPL for the bullish entry into the 67.40 call option. Close 17 on close this candle. 9:36 hits mid R1 R2. Close this candle 23.80. 9:46 a.m. hits the R2 level. Close 25.70. Next we'll look at the 67.40 put. Here's the 67.40 put. Here's the 10:56 a.m. closes below the BBKPL right after the Trump tariff news. 10:56 a.m. Close of the candle, $13.50. That's your entry price. Very next candle hits midpoint S1, S2, YDL, S2, as well as the midpoint of S2, S3. Close $30. 11 a.m. candle hits S3. Close $50.75. 11:18 candle hits mid S3 and S4. Close $64.72. 11:20 a.m. hits mid S4, S5, $76.65 on the close. 11:24 a.m. hits S5, $91.55. 11:30 a.m. candle hits mid S5, S6. Close of that candle, 101.50. And the 11:32 a.m. candle hits S6, 111.62. Next will be the last part of the video, the 25 minutes, which goes over the taking bullish and bearish trades off of the other main levels when we get through after the first morning part of the session, how to take bullish and bearish trades off of the main R1 through R6 levels, as well as S1 through S6, X6 levels, as well as the two different types of trades, your standard entry trade and how to recognize that, as well as the more conservative approach, which is the alternative entry, which requires additional confirmation for that entry and how to recognize that. Hello, in this video we're going to go over how to take trades off of the other main R and S levels. So this would be taking trades off other levels besides the bull bear key price level. So the main R and S levels are your R1 through R6 and S1 through S6. So if we zoom out here, we'll have R1 through R6, S1 through S6. The levels that show up as default on startup with this indicator are the PMH, PML, YDH, YDL, and YDC. So that's the pre-market SPX pre-market high, SPX pre-market low, SPX previous day RTH session high, SPX previous day RTH session low, and SPX previous day RTH session close. So the previous days are YDH, YDL, and YDC. So that's yesterday's high, yesterday's low, yesterday's close. PMH and PML are the current session's pre-market high and pre-market low. So pre-market high, pre-market low, YDH, YDC, and we move down. Here's the low from the previous RTH session. Also in startup, you will have R1 through R6, the bull bear key price level, and S1 through S6. You will also have QL above BBKPL, QL below BBKPL, the first midpoint above the BBKPL, and the first midpoint level below the BBKPL. And this is because in 95% of the sessions or so, your trades at the beginning of the session, if you decide to take trades at the beginning of the session, are primarily going to be based on price action at the bull bear key price level. However, there is no rule or obligation to take trades off the BBKPL. It is there for the session bias, to give you a bullish or bearish bias for the session, as well as the trades that you can take at the beginning of, like I said before, 90-95% or so of most sessions that you will see. However, you can just wait until price action bears out further on in the session and take trades off of the main R levels or S levels. As we've discussed in other videos, when you're taking a bullish trade off of the bull bear key price level, your tight stop loss is the QL below the BBKPL on that bullish trade triggered from the BBKPL level, and your standard stop loss is the first midpoint below, which would be mid BBKPLS1 for a bullish trade taken off of the BBKPL level. Conversely, on a bearish trade taken from the BBKPL level, your tight stop loss is the QL above the BBKPL, and your standard stop loss for a bearish trade taken off of this BBKPL level is the first midpoint above the BBKPL, which is mid BBKPL R1. The same principles applies to taking trades off of the other levels. So if you're going to be taking trades off the other levels, then you simply need to turn on the quarter levels if you're going to be considering taking tight stop losses, or the midpoint levels for standard stop losses. So for example, if we're looking to possibly take bullish or bearish trades off of R1 or R2 or S1 or S2, then we would simply turn on the QL levels above and below those levels, as well as the midpoint levels. So you simply go into the user control panel, and first we'll turn on the midpoint levels. So we'll enable mid R1 R2, mid R2 R3, mid S1 S2, and mid S2 S3. And let's say we're also considering tight stop losses. Then enable QL below R1 and above S1, below R2 and above R2, and then the same thing for the S levels. Above S1, below S1, above S2, and below S2. Now you can leave it this way if every day that you want to consider taking trades off of this level. Just know if you reset the settings, it's going to go back to what I showed you before as the default. So for example, right now we're just showing R3 through S3. So for example, if price is coming down to S1 and bouncing off of S1, and you want to take a bullish trade off of S1, then your tight stop loss on a bullish trade is the first QL below S1, because S1 is the level that you're taking the trade off of. And the standard stop loss would be the first midpoint below S1, which would be mid S1, S2. So instead of a bounce off of here, if price came below here, then went back up and crossed above and closed above S1, and you wanted to take a bullish trade off of S1, it would be the same thing. You're taking a bullish trade off of S1, so your tight stop loss is the QL below S1, and your standard stop loss, if you choose that one instead, is the first midpoint below S1, mid S1, S2. Let's say the reverse happened. Price is slicing through S1 and closing below S1, and you want to take a bearish trade off of S1. Then on a bearish trade from S1, your tight stop loss is the QL above S1. And on a bearish trade on S1, your standard stop loss is the first midpoint above S1. So always just remember that on bearish trades from any level, your tight stop loss is going to be the first QL above that level, and your standard stop loss is going to be the first midpoint above that level for bearish trades taken from that level. And on bullish trades taken from any main level, your tight stop loss is going to be on bullish trades taken from the main level. Your QL below that level, and your standard stop loss is going to be the first midpoint below that, whatever level that is. So on R1, if we were taking a trade of a breakout above R1 and we're taking a bullish trade, then our tight stop loss is the QL below R1 because that's the level we're taking the trade from. And our standard stop loss, if we choose that instead, is the mid BBKPL R1 because that's the first midpoint below the level we're taking the bullish trade from, R1. If we were taking a bullish trade on a breakout above R2, then our tight stop loss in that bullish trade on a breakout above R2 is QL below R2, and our standard stop loss on a breakout above R2 is going to be the first midpoint below R2, which is mid R1, R2. Now, in the reverse, let's say the price goes up to R2. Now it starts closing below R2, and we're looking for a bearish trade off R2 to move down below to these levels below. On a bearish trade from R2, then our tight stop loss is the first QL above R2. If we choose instead to use a standard stop loss for our bearish trade taken off R2, then the standard stop loss is the first midpoint above R2, which is mid R2, R3. Same thing if we're taking a bearish trade off of R1. If we're looking for a bearish trade off of R1 or break below R1 or a touch and fall off of R1, then our tight stop loss on the trade taken from the R1 level is the QL above R1, and our standard stop loss on this bearish trade taken from R1 is the first midpoint above R1, mid R1, R2. Same thing applies to the S levels on bearish trades. If you're taking a bearish trade based on price action coming down, closing below S1, then your tight stop loss in that bearish trade taken from the S1 level is QL above S1, and your standard stop loss is the midpoint level, the first midpoint level above S1, which is this mid BBKPL S1. On a break below S2, then a bearish trade taken from S2 is the tight stop loss for that. On a bearish trade taken from S2 would be the first QL above S2 here, and your standard stop loss would be the first midpoint above S2, which is mid S1, S2. Same thing applies on S3 levels. If this was a bearish trade we were taking because price started closing below S3, so on a break below, close below S3, our tight stop loss would be the QL above S3, which we don't have because we didn't enable it on this chart, but it would be the first QL above S3, or if instead you're choosing to take the standard stop loss for your trade on a bearish trade from the S3 level, then it's the first midpoint above S3, which is mid S2, S3. Same thing for a bullish trade above R3. Break above, close above R3, then your tight stop loss would be the first QL below R3 because we're taking a bullish trade looking for price to go up, continue going up. So you would enable QL below R3 if you want to use a tight stop loss. Keep in mind that if you're just using standard stop losses, then unless you have some reason why you want to see where the QL levels are, there's no reason to turn them on. So if you're just going to be using the standard stop losses, then you would just want to have your midpoint levels turned on, unless for some reason you also want to see, just for context, where the QL levels are. So again, in summary, if you're taking a bullish trade off of either the bull bear key price level or any main level, whether it's an R level or an S level. If it's a bullish trade, then your tight stop loss, if you choose to use that, is the first QL level below the level that you're taking the trade from, and your standard stop loss is the first midpoint level below the level you're taking the trade from. The opposite is what is on bearish trades. On bearish trades, then if you use a tight stop loss, then it's the first QL level above the level you're taking the trade from. If you're taking a bearish trade and want to use a standard stop loss level, then your standard stop loss level is the first midpoint above the level that you're taking the trade from, the bearish trade from. Bearish trade from R1, standard stop loss is mid R1, R2. Bearish trade off of R2, looking to go down, your standard stop loss is mid R2, R3. Bearish trade from the BBKPL, your standard stop loss is the mid BBKPL R1 because that's the first midpoint above it. A bearish trade taken from the S1 level, your standard stop loss is the first midpoint above S1. And again, on bullish trades, it's the opposite. It would be the first midpoint below. So if you're taking a bullish trade off of S2, first midpoint below S2 is your standard stop loss. Okay, so now we're going to take a look at examples of both standard and conservative entries, both on bullish entries and bearish entries. So first off, we're going to look at bullish entries. So here we have a cross above and close above. So we have a candle that the same candle is crossing above the level in question, in this case the bull bear KPL, but it would not matter what level it's on. So regardless of what level this is, you have a cross above and close above the level. That is your bullish entry on a cross above and close above the level in question. Your second option is take a more conservative bullish entry approach. And on the more conservative bullish entry approach, you are requiring a retest of the level, a successful retest of the level before entering your trade. So in the case of a bullish trade, you're waiting for a successful bullish retest of the level in question before entering your bullish trade. So on this more conservative option, the sequence is you have a cross above and close above the level, which we have here, followed by price falling back to test the same level successfully, meaning it's coming back down, it's not closing below the level, it's successfully retesting the level and closing above the level. So it's cross above, close above, fall back to retest on a bullish trade, close again above that level. That is your conservative bullish entry that requires a retest. Just keep in mind that if you are going to focus and use the more conservative bullish entry that requires a retest, that many times price, after initially crossing above and closing above, will just continue to keep closing above in successive candles, and there will be no retest. So just keep in mind that if you use the more conservative entry, there are going to be times where you are going to miss entries because there is not going to be a retest. In this case, there was a retest. So again, just to go over it again, the standard bullish entry is a cross above and close above the level in question, in this case the BBKPL. So you would enter on the close of this candle here. Or if taking the more conservative bullish entry approach, you're waiting for a successful retest for price to fall back to the level in question, but still close above the level in question. And that is your successful retest. So you would enter, you could have entered on this candle, or if you did not on those, you could have entered on this candle here, and it did retest the candle here. We had a retest here, but if you waited for this retest, you'd be paying a lot more. So usually the successful retest, you're just waiting for the initial successful retest. So this is the initial successful retest. This is the initial cross and close above. This is the initial retest. Okay, so just to take this one step further here, so as you can see here on the R1 level, we had a cross above and close above this level. So if you missed this entry here, or if you're just the kind of trader who you prefer taking trades off of other levels besides the bull bear key price level, then you have a cross above, close above here, and you would take that entry here, and you would base your entry on the R1 level. Now, just to clarify, the stop loss on either one of these entries here, down here, whether you took this standard bullish entry or the more conservative retest required bullish entry, your standard stop loss is the first midpoint level below the level in question you're taking the entry from. So in this case, on this sequence here, this is taken from the bull bear KPL, so your standard stop loss is the first midpoint level below the level in question, the bull bear KPL, so that is this level here. We don't happen to have the quarter levels on this particular chart, but if you instead wanted to use a tight stop loss level, then you would enable the QL below the bull bear key price level, and that would be your tight stop loss on this trade. And the QL is the midpoint between the midpoint and the main level. So on the new version, the 2.0 version, you have the auto plotting of the QL levels if you simply enable them. But here, as you can see, the tight stop loss would not have been hit either. But just keep in mind that on any entries, whether it's bullish entries or bearish entries, the tight stop loss is named a tight stop loss because it is tighter and there's more chance that it will be hit than the standard stop loss. So if you're going to use the tight stop loss, you're going to have less at risk because you're using the tighter stop loss. But conversely, the con side of that is that there's more chance of it getting hit. So you just have to be mindful of that. If you instead, like the second point we're getting at, if you waited to take an entry off of the R1 level on this cross and close above, then your standard stop loss on that trade is the first midpoint below the R1 level, which is this mid BBKPL R1. And if you instead took the tight stop loss, then it would be the QL below the R1 level, which would be the midpoint between this level and this level, which again, on the new V2.0 indicator, those auto plot as well, the QL levels. Okay, now we'll look at a bearish entry. Your standard bearish entry, you enter a bearish trade on a cross below and close below level. So here we have a cross below and close below the R2 level. So you would enter a bearish trade on this cross below and close below if you were looking to take a trade off of the R2 level and you were open to bearish trades off of that level. this would be your signal to take the bearish trade on a standard bearish entry. Your standard stop loss on this bearish entry is the first midpoint level above the level you're taking the bearish entry from. Since the bearish entry is from the R2 level, your standard stop loss is the first midpoint level above the mid R2, R3 level. And if you chose instead to use a tight stop loss level, then it would be the QL above R2, which in this case would be about right here. And again, on the new V 2.0 indicator, it will auto plot that level for you if you go ahead and enable it. Now, looking at the more conservative bearish entry, it's just like the bullish one that we did, except in reverse. We're waiting for a successful retest of this level before entering the bearish trade. So in this sequence, it's basically the reverse of this sequence down here for the bullish entry. In this sequence, we have a close below candle. Then price rises back up to test the level in question and then closes below that level again. That's a successful retest of the level. So this is where you would enter on a successful retest. You could have also entered here. That would have been a little bit later, but that, either one of these candles here would be considered the successful retest. So even on the successful retest, since it's off of this level, it's the same stop loss. First, for a standard stop loss, the first midpoint level above, which is mid R2, R3, that's the first midpoint level above this R2 level. And if you chose to use a tight stop loss, it'd be the same as what we talked about with the standard entry. It would be the QL above R2. And the same thing would apply for any other level. So if this price action was happening down here on this S2 level instead of here on this BBKPL level, then it would be the same sequence. Cross above, close above, that's your standard entry. Cross above, close above, then retest and close back above, that's your conservative successful retest entry. And then your standard stop loss on an S2 level bullish entry is the first midpoint level below S2, which is mid S2, S3, and then your tight stop loss level on a bullish trade taken from the S2 level is your midpoint, the QL below S2. Okay, I hope this clarifies the entries and also taking entries from the different levels for you. Thank you.